Ah, thank you. Thank you. Thank you. I have been trying to. Yeah. All right. Let's talk about the asset allocation landscape. Right. Is it easier for you guys if I stand here? Then you can look at the crowd. Apologies for my back, but you can now hear me, right? Good. All right, let's talk about the asset allocation landscape. I have my eye on someone. I won't call them out yet unless they grab the microphone, then we're good. How are you viewing asset allocation today, given Regulation 28, volatility and liquidity considerations? We heard it somewhere earlier today that Regulation 28 isn't being used as efficiently as it could be used. So are you making any trade-offs? Yes, Adam. Are you making any trade-offs?
Yeah, so I think when you put me up in a forum like this, you run a big risk, because I often have a different view from most people. And these are my own views and not necessarily the views of my trustees. It's a personal view. So I think I differ from Ben when he spoke earlier. Regulation 28 is not a target. It's not saying that so much must go into this and so much is going to that. It's basically, it's a prudential requirement that you may not invest more than this in that asset class. People, I think, must take it to say, oh, well, now, because you've got a certain percentage allocated to a certain asset class, you must invest that much in that asset class. That's not how I understand it, and that's not how I think it was intended. So Regulation 28 in our world, I don't think it's really added much. It's just we've always operated on a certain basis. There's a strategic asset allocation. The strategic asset allocation is determined. First of all, there's an asset and liability model. What is it that the returns we're trying to target? That then determines the strategic asset allocation, and then the assets get allocated according to that strategic asset allocation. And that strategic asset allocation that we have would not be far off from what Regulation 28 would do. So that's how we see the world. And the other thing that I think people often make a mistake, and sorry I'm digressing, the most important thing in investment is your strategic asset allocation. Because if you get the asset allocation right, even if you pick the worst manager in that asset class, you'll do well, right? But if you get the asset allocation wrong, even if you pick the best manager, you're not going to do well. So, I mean, that's my view. I accept that there may be different views to that, and happy to listen.
It's a different view.
Okay, so I'd like to add, so for me, I hear the argument about it being restrictive, but sometimes as a pension fund institution, you also have to look at your members, right, and the age, right, because I think with EPPF, what we're finding is that we have more non-active members than active members, and from a liquidity perspective, you have to think about it from that perspective as well. So what we are then now doing as EPPF is now trying to segment between active and non-active so that we manage the liabilities correctly. So we'll match the liability for non-active members, and then from the active members, that's when we'll have then our pool of assets that will look at your long-term investors, because those segments can stomach the long-term investments versus your non-active members, which are then your pensioners. So it also sort of guides us in terms of how we do our SAA, but we're going to separate our SAA between two segments of our constitution.
Yeah, if I may add, so for those of you who don't know me, Marte from 27-4. So I think one of the conversations that we keep on having with some of our clients, we run a fund of funds, and we've got institutional pension fund clients, and it's always this risk-reward game, right? So there are all the strategic asset allocation kind of parameters. There are the Regulation 28 that sets the limitations and so forth. There's a liquidity point that I think is an extremely important one, this kind of, seeking liquidity within even a private markets asset class. There's the talk about impact and everything else. But when we kind of have the conversation and we kind of, get down into the nitty-gritty, it's always this, why am I taking the risk on this private asset class for this return when I can take lower risk in a different asset class for a similar return? And you always are in a position where you're defending that kind of, decision from a trustee's perspective in terms of their allocation thinking. So I think it's important, right? Like it is, we always talk about like the performance needs to be there and everything else. I know specifically your CIO talks performance on every single panel, but it really comes down to that, right? Like, because the trustees, in how they think about it, is where can I get the most returns for the lowest risk in order to meet my asset liability kind of matching obligations, and kind of that impact is there. They're always looking for something that's more impactful. It's certainly a thematic that we have in every single conversation. But it's safe to say that they're looking for the listed market to achieve the same, right? They're holding listed companies just as accountable to impact and governance and all the rest, you know, positive contribution to community. So, you know, I think this risk reward is definitely like a critical part of the conversation that we constantly have when looking for, you know, to the allocation conversation.
Okay, so that's really helpful. Did you want to add to that, Teresa?
I think the only thing I'd add is for us, when it comes to the private market space, we look at it as a lever for impact, as opposed to the other considerations by the other panelists, because our AUM is heavily skewed towards listed, and that's where we play the liquidity game. Our unlisted allocation is way smaller, and for us, that's where we can derive impact. So in our unlisted area, liquidity, it's still important, but it's a lesser factor, just given the size. With that.
Stuart's the one asking the questions about exits.
Yes.
Just joking.
Okay, so if that's the case, we're talking about risk, we're talking about liquidity, all of those things. How do you then see this playing out in this emerging manager space? Right, who's going to be the winners and the losers? Trick question.
I can go first. So how we are looking at the private market space, historically we did a lot of private equity, which is, it's typically 10 years, and it will literally be 10 years and longer in most cases. So liquidity becomes, you literally get liquidity at the end. Unlikely to get it prior to, the end of the fund. So what we're doing now, and obviously that has an impact on returns, right? If your liquidity is back-ended. So how we are looking at things now is we're leaning more towards real estate and infrastructure, because there you get, liquidity much earlier because of the income nature. So that's what we are doing as PIC right now. We're doing your traditional generalist private equity very selectively, because we'd rather see, we want more liquidity now, just for more for performance, because we've seen with our older portfolios, the performance wasn't so great, and those portfolios are full of your private equity funds, because we saw exits as a challenge, with our GPs, and those exits, they come by blood, sweat, and tears, and at the very end. So those returns were, not very good. So now we see real estate and infrastructure as an opportunity to just turn things around.
All right, so focus becomes a big thing in terms of mandate. Chad?
Maybe just to add to that, like if I think about it from a basic risk perspective, right? So if you invest in a credit portfolio as an example, the biggest risk is default. Like if you just simplify it, how do you get rid of that risk? You diversify. And so within an emerging manager framework, yes, we try and find the best teams, we try and find the best strategies, but ultimately it's still about diversification. And so we're sitting in a room with one of the better teams.
Thank you.
No one's going to attack. I'm trying to get Mal not to ask me any of the difficult questions. But then I think about it from a diversification standpoint, because I believe in any program, if you're investing in unlisted, something's going to break. Something's not going to work. And it's preparing for that outcome rather than trying to avoid that outcome, I think is the starting point for solving for that.
I'll also add, just because we've probably got the smallest, as you heard, from an AUM perspective, from a size and allocation, and we run it on a fund-to-fund basis. So portfolio construction is key. Like I asked Ben, he was mentioned to some of our conversations early on when I was still working for PIC. And I'm absolutely obsessed by portfolio construction. I think the ability to be deliberate about portfolio construction is fundamental. And I hold, ourselves, we should hold ourselves as allocators to that same bar, right? We keep on saying diversify, even if you're within a niche, find ways to diversify the risk, investing in, maybe different geographical areas or managing your prudential limits in a certain way. And for us, that's also kind of extremely, extremely important. And not just from our primary allocation perspective, so looking at an emerging manager, we would never in our program, which is only focused on supporting emerging managers, invest in emerging managers that all have the same qualities, right? Like I'm talking even from a personality perspective, from a network perspective, from who they access in terms of their IC, how they run their investment processes. Yes, we like it when things meet a certain benchmark, but we're also looking for the differentiating quality that each of them bring within their strategy, how they think differently, how they act differently as operators and things like that. And then from our perspective is we want co-invest. So we want to support the emerging market even through co-investment as a product. And I think that's equally important to us in terms of the model that kind of we have. As a result, though, we are, I suppose, less willing to invest in kind of things that are real asset-based necessarily. It's a limitation of mandate thing more than a willingness or an opportunity or anything like that. But that's the difference, right? Not all LPs are going to be supporting all emerging managers in exactly the same way with exactly the same level of allocation. And then, sorry for hampering on about this, but portfolio management, like actively working with emerging managers in terms of where there might be weaknesses or where there might be guidance required is, the onus that's upon us in terms of our fiduciary duty to our clients and, speaking up in the LPACs and having a view and, once again, holding ourselves accountable just, to the same extent to which we hold the managers accountable becomes really, really important.
Well, I'm glad you did that because I think our executive team will tell you that you sound like our board meetings.
Okay, so I think I've got once again, a bit of a different view. So Rescura is our investment advisor, and 90% of the time I agree with what Rescura does. But there are times when I have a radically different views. So the Murphy's been very at the forefront of assisting emerging managers, and I think the trustees would be very proud of the fact that there are a number of managers here, not here, but today, who would not be around if Murph was not one of the first to cut a check to them. So well done to the trustees. But I think where I have a different view from Rescura is when my son was in school, you'd go to the prize giving and everyone in the class won a prize. And you say, but what the hell? I mean, can everyone win a prize? I mean, it's madness, right? So why must I come first if everyone can win a prize, right? And when you have like 50 managers in an emerging manager program, then what are you doing? Like everyone gets money. So you get 50, you get 100, you get 25. What are we doing? And you're not going to create the next Coronation, the next 91, or the next Ellen Gray if nobody's willing to bet on someone and bet big. And that's my view, right? But I'm a voice in the wilderness here, right? So, I mean, I'm the one guy who got this view. There's not many people share this view, and many people won't want to say this in public, right? But, I mean, that's a view. People have different... Trustees don't support me on that view. Me and Jared don't agree on this view, but that's his view, and he's the investment consultant. I'm not. I'm just the PO, right? But that's my view.
So let me taunt the bear. I think there's enough money in the market to support 50 managers at R1 billion each per retirement fund. I know that's not going to happen, Adam, but in my dreams, right? In my dreams. No, but I understand what you're saying. There is an oversaturation of emerging managers in the market, and I think one of the biggest issues at the moment is performance, and we've seen that. Emerging managers that have been performed haven't been able to deploy the capital, haven't been able to exit, so that track record hasn't come to fruition, and it is skewing the data, and it is deflecting from those managers that are doing well. So maybe let's talk about that for a minute. Let's talk about accountability and some of the concerns that you have around emerging managers and some of those concerns that you face as an LP. I know that you... No. I also actually want to put Vukile on the spot, right? Because you took a jump when you made this investment, right?
Yeah. I mean, I'll give you our perspective is slightly different, so it's so enriching to listen to all of the different perspectives. So we took what we call a 2% bet. We're a property business, we're a REIT, and I mean we looked at it across probably 2 or 3 dynamics. So the first one was, really backing. Someone that we think could deliver change that we felt was needed. So it's almost disrupting the environment, backing a jockey and a team to explore an area of the market where we felt there's significant growth potential. And I think that was one of the elements. But why do we think this was the right team to back? We always look at deploying capital, whether it's locally, kind of regionally, internationally, across, it's almost kind of that modern portfolio theory type thinking, right? Return, risk, having everything run, so limit your risk to maximize your return. And we just felt that there was something in the space around, critical mass, back in the right team to get those returns. So, is this something that we would potentially look to do again? I think we've also had a lot of learnings, cross learnings across the 2 businesses as we've explored, this partnership. So I think, we've definitely done the right thing by backing, this team. It's invested well. The returns will come. It is a J-curve type, area where we're playing in. But I think it's going to make significant changes, to the environment of investing in this space, and I mean I think it's something that we should be doing a lot more for sure. So that's the context of why we got involved in this.
Oh, and that's why Vukile is an LP. I think our purpose were aligned on this one. Marde, did you still want to add? Khabang, you want to go?
Yes, so I think you were asking around challenges that we faced.
Yep.
So I think if you look at the history, EPPF was one of the early investors when we were trying to transform the market, right? With backing a lot of asset managers in the past 10 years. And we backed managers with no track record, we just, went on gut feel. And it hasn't proven to be successful. And I think that's why we took the stance of not backing any first-time fund managers anymore, and then created the TUSO program, where we invested via third party, thinking that it might be better because they've got better support than what we can provide. And, so we appointed TUSO to sort of assist in that space. The numbers are coming through, but it's not covered in glory, but it's still early stages. But I think that's when I think EPPF took a decision that we're going to limit the supporting emerging managers because of lack of track record. And something that has been coming through a lot, and I think Marde mentioned that our CIO is very persistent on performance, financial returns, as well as impact. And obviously if the impact is more on this side and the return is like 2% difference, like 16 and 14, we'll go for the one with 14 but with a better impact. But we do want to see our hurdles, being met. And so I think for us, the biggest thing when we look at a manager's track record, and if we can't ascertain what you've done because you've been backed by maybe a big name like Standard Bank and you haven't been out on your own in this big bad world, we don't know how to then track what you've done. So it's very difficult for us to do that. Hence, we want third-party, service providers to assist us with our supporting emerging managers.
So maybe just stick there for a minute, just define emerging managers for me. So if you're no longer going to back emerging managers as EPPF, but you will do it through programs, where would you as EPPF on a standalone basis start backing a manager?
So right now we're thinking probably on your second or third, and I know emerging is defined differently in South Africa and globally. I think globally, if you're on your third or fourth fund, you're still an emerging manager. But here we define emerging manager, I think maybe as your first time fund manager, which is probably we can be different. And that's what we're also trying to work through to say, do we have first time fund managers and then still call your second fund emerging, or because I think we sort of use the words interchangeably between first time and emerging manager, but I think in this instance, I mean first-time fund managers, and then we'll back you on your second fund because you would have had a track record that we can go back to look at and say, okay, your first fund, you did well. But it doesn't really mean because you did well in your first fund, you'll do well in your second fund, because we'll look at those nuggets to see, is it one star wonder in the asset that did well and then all the others didn't do too well, and we'll look at those things to see if your track record does stack up.
It's the difference between a good manager and a great manager, right?
Here's my big bugbear with that, if I may. Um,
I'm loving
You
this.
do not know whether a fund manager is a good or a bad manager when they start raising their fund too, right? Because they've maybe constructed a portfolio, so there are elements that you know they may be well in. Do they have the networks to source deals? Are they deploying at a rate that mitigates against the J-curve? Are they possibly even managing the way in which they incur expenses and draw fees to minimize the J-curve? You know, is the critical thinking that they're applying to their portfolio construction right? Yes, those are the things that you can check. But the expectation, especially within a real asset class, I'll say that specifically because we're in this forum, is to have exited or demonstrated any level of DPI on that portfolio by the time you go into a fund to fundraise is absolutely impossible, right? Like, there are fund managers that have done it in terms of first-time fund managers that are very high, but they're private equity. You know, some of it has been massively luck. You know, one single asset that has created that, and all credit to them, that was part of their portfolio construction. But I think you have to go through the cycle. I think that if you compare how allocations happen in global markets, where, you know, the likes of very sophisticated allocators, if you back a manager in the first fund, unless they do something that is lacking integrity, they've committed fraud, whatever the case might be, they've gone against the mandate, you are almost expected to write them a check in Fund 2 and then in Fund 3 as well. In order for them to ride, well, you want to ride all three of the cycles. I think that's important. You don't want to be like exposing yourself to a vintage and then the macro turns and then that's important. But you also want them to, you know, have the ability to prove themselves over a number of funds that gets them sustainable, especially if you're supporting emerging managers, where they then can go to the purely commercial market and raise capital. Because I can tell you today that there is not a single emerging manager in South Africa, and I'll bet my life on it, that can raise capital from any global market as our macro sits today, as the performance sits today, even those that have, you know, 1 times DPI on their entire portfolio by the time they raise 2. They are not getting backed by the institutional, commercial, you know, capital that you see being deployed in other emerging markets or the rest of the globe. It just doesn't exist. So the programs that we design need to kind of take that into account and continue. And, you know, we've got flaws in our own programs as well, because you're trying to match what clients are willing to support and allocate capital behind, and their risk appetite to what you know is right for the market. But it's something that's, you know, needs further kind of debate and discussion and mechanisms designed around in order to kind of mitigate.
Can I keep you on the spot, Mardo?
Sure.
Okay, so while we're on this topic, so you know that we've got a Fund 2 ambition. We're not entirely sure what that Fund 2 ambition looks like. We're starting to strategize towards the end of the year. Might take various formats. But given we couldn't get you into Fund 1, how do we get you into Fund 2?
Oh, we need a different mandate. So no, I think it's a you know, fair question to ask. I hope Ben and them would admit that the reasons why we don't allocate is not that we don't add value. We try to add value regardless of whether we allocate or not, even if it's just through participation in the market or one-on-one conversations. So I would start there. Secondly, I think that, you know, for any fund manager to go into a conversation on a fund 2, the reality around DPI cannot be ignored. Everything that I said previously holds true, and it's 100% the reality that the kind of entire market faces. But I doubt, and not to put you on the spot, or EPPF on the spot at all.
Put them
And
on the spot,
no,
Madeleine.
that any institutional investor would have a very serious conversation with you if you can't at least demonstrate some level of DPI post your investment period, right? So if you go then you're like 0 returned, but look at my valuations are like 2 times. It doesn't actually mean anything because none of that value has been crystallized. So I think that it plays into the portfolio construction where you have to find a way to realize some level of yield on a portfolio of assets that you invested in, early, in order for that to come through to some extent by the time. Even if you just do a partial sell down of an asset, that helps immensely in terms of kind of that conversation. So I think that's extremely important. I think, unfortunately, I think that the mandate of the investors are so limited in what they can and cannot do. Like ourselves, we wouldn't be able to, with the mandates currently that we have. It doesn't mean that we're not trying to raise ourselves more mandates to be able to invest in the asset class. But I think that's a clear limitation. And even directly from a pension fund perspective, it changes, right? As trustees change over time, fund 1 is not the same as fund, 2 and when you're raising. So I think that, following those mandates, knowing what that looks like by the time you're raising your fund 2 becomes extremely critical. I always say, when we're lecturing and all of that stuff, is that, you should know more about an investor when you walk into the room than they know about their own institution when you're fundraising. And that's very, very true, right? So go have the right conversations with the right people, have some level of DPI, show that you've complied with your existing mandate, show that everything that was previously promised to your Fund 1 investors are, you've executed against, you've done. I love the innovation bit of what you guys are doing with the platform and everything else. That's extremely key. Show the lessons learned. So where it's gone wrong, like your transparency around talking about where it's gone wrong is absolutely key. I hate it when, I sit in front of a fund manager and they go, yeah, no, it's all just gone well. Like, I actually don't like those kind of fund managers because when it does go wrong, they don't know what to do, right, in that environment. So I'd rather back a fund manager that's been able to restructure to some extent or react to a situation where it's been very, very difficult to deal with a situation, survived it, built value from that, or even just recovered value from that, then have a situation where somebody actually doesn't know. So it's not a direct answer to your question just because we don't have mandate, but I do think that those things and factors are important in terms of picking up conversations. And obviously starting with your existing LP base. I don't know what Itumeleng was insinuating about Fund 2, but having a reason for why they might or might not be in it would be a key conversation that every single investor will be asking you, especially because they're not the same type of allocator than the others that are sitting here.
So maybe we should have that conversation with the rest of the panel and say, what would you be looking for from ALT in terms of its Fund 2 ambitions?
Are you asking in order for us to consider committing to Fund 2, basically?
Absolutely.
Okay. For us, performance, Fund 1 performance, and there's a few factors there. Portfolio, firstly deployment, because I think we take it for granted, but not all, GPs are able to deploy the capital that they're entrusted with. And especially within the allocated time. So I think we shouldn't discount the ALT team's ability to not only deploy, but deploy in the quick space of time that they have done. That creates a lot of confidence that our capital will be put to use. So that's something that we look at. And then secondly, how they have deployed in the portfolio construction. We look at, have they stayed true to what they promised? They promised us geographic diversification. They promised us to look at certain sort of overlooked areas in the country, So the provinces that they're in, the towns that they're in, the areas that they're in, do those align to the strategy that was sold to us? We look at that. Then thirdly, we look at how the assets are doing. We know that not everything will always go according to plan. There'll be battle scars. Where we have had those, how has the team addressed those? Because that, that leads to maturity that you'll be able to, implement going forward in the next fund. So that we can have confidence that the lessons from Fund 1, they'll help you to make better decisions in the next fund. And then we look at impact. We are one of those investors that when we agree to certain ESG transformation and impact targets, we contract on those. We put them in our site letter. We have the cap, as the team has mentioned today, and where, the team breaches or doesn't achieve what they are supposed to achieve within the agreed timelines, we have penalties, such as...
We haven't been given any penalties, I just want to say.
Yes, which eat into the team's bottom line. So very intentional about that. So we would look at those matrices in arriving. We'd also consider DPI, like Marde would. But however, for us, the absence of DPI wouldn't stop us from, considering a follow-on investment if the other, the other matrices, tick well. Because we understand where the fund is in its life. So we wouldn't now sit out Fund 2 because there isn't DPI yet and say, oh, we'll wait for Fund 3, you know what I mean? So yeah, those are the key things that I'll mention for now.
Thank you, Teresa. Gadang.
So for us, if anyone that has met Kagiso, you would know that DPI, you know that DPI is the number. So you put me on the spot, so definitely DPI. If you've met Kagiso, you'd know that's the first thing he checks. So for us to consider allocating in your second fund, definitely your DPI number, your track record in terms of the ability to exit. So depending on where you are in the life cycle, we want to see the ability and demonstration that a manager can exit, because that's something that we stuck with on the PE side, where managers are not exiting, and we want to see a demonstration of exits. Impact as well is something that's starting to be something that we look intensely into. I know we haven't been contracting for it like PIC, but we are moving in that direction as well. So I think, Ben, you've been to our Beyond Tomorrow conferences where we spoke a lot about our sustainability pillars and where the spaces that you play in, social injustice, environment, as well as, sorry, I forgot what the third one is. So yes, gender parity. So yes, so those are the things that we look into and will intensely look into and contract for. And yeah, so I think those are the two. Your financial performance, your DPI number, your ability to exit, as well as the impact.
Okay, and just on that impact one, how big a role does climate play in that consideration?
So we've actually, because we are a Net Zero Alliance, we're part of the Net Zero Alliance, we are starting to collect Scope 1 and Scope 2 emissions, and we will evolve with time as, we getting more requirements from the Net Zero Alliance. So it is very imperative that you as a fund, that you start tracking these emissions, because we are starting to collect them. And I think from last year, we've started reaching out to fund managers to collect that data. And if you are not collecting that data, we are offering workshops to start, to align our managers with how they can collect that data and, align them with what we need as a fund.
Perfect. So that's definitely going to become something that will differentiate a fund going forward.
Yep.
Fantastic. Chad.
I won't talk about DPI, although it is important. Wasima beat you to this question over lunch. So she spoke a lot about, hey, if Fund 2 does this, would you consider...
They're well trained, Chad. They're well trained.
I was like, yeah, Wasima wasn't originally going to sit next to me, so I don't know.
No, what happened there?
But if I think about what hasn't been mentioned that I think is important, it's the team. Ben spoke earlier about mental well-being for certain team members. If I scratch through my notes from the early days of engaging with the team, that's one of the things I noted is capacity within certain functions of the team. I think that's important. Ideally, if we think about the private equity framework, you're looking very much at what money has come back. In real assets, I think there's a debate, and I don't know if we're having the debate today, but I think that there should be a debate around, is it the right thing to kind of push this closed fund framework, closed-ended fund framework, and push the exit of good assets, even though there's no real reason to exit good yielding assets. It's a mindset that I don't think everyone maybe thinks about, but I do think that's a debate as an industry we probably need to have, because I see a lot of people just pushing the same asset around and different vehicles. Is that really what we want, or is it actually if we're getting a good yielding asset, which is difficult in SA if you think about what you can get from a government bond, but I think that's part of the debate that we should have. Okay, I'll finish, guys. Thank you.
And I think that's a really important point, Chad, because it's come up in our strategic discussions, right? Despite what might be happening in the market, we believe there's a place for open-ended funds. And potentially our vehicle is one that, or the asset base that we are pursuing is one that will well suit an open-ended investment structure alongside potentially a closed-ended fund, right? And the one becomes the off-taker to the other. So really important points. Thank you, Chad. And well done, Wasima.
Yeah.
Itu.
Yeah, I mean, I'd start by saying, the guys need to smile a bit more. They'll potentially look to consider. I mean, I think the guys have mentioned most of the stuff that I've thought about, right? So it's performance, it's growth, it's deployment. I think the team is a big one. But then I'd add, to also really institutionalize the operations and policies and processes of the business. So they almost kind of, outlive individuals. So it's not a person, it's a desk. I mean, I think also it's not something that, this team doesn't have. Really exploring more depth around governance across the spectrum. I think those would be very interesting things for us to explore, and those would be all the inward-looking things that I would consider, part of the discussion that I'd have with the team. But then I think there'd also be, external, outside forces that I would probe, right? So how are we dealing around issues of, social challenges? Have we quantified it? How are we quantifying it? How are we dealing around political challenges that we have? Where's the leadership? How are you thinking about that in terms of sustainability? So to me, it would be, those would be the list of questions that I'd have on the agenda. But ultimately, risk-adjusted returns would probably be right at the top. So if you don't deliver, if the operational efficiency isn't there, you don't collect the rental, top line doesn't grow, that the rest of the agenda is pretty much moot, I think. So those would be the things that I think about.
I'm just checking, Itu, do your shareholders hold you to the same standards?
Every 3 months.
So I think, just from my point of view, I think there's one thing at Murph that annoys us, is when you have an emerging manager and then the guys end up fighting and someone leaves, then our confidence level goes. Chad gets a call and he's already in the firing line as to why he chose those people initially. And, we just think that, and that's something that you really, all emerging managers really, really need to guard against, because nobody wins in that environment, and it's just sad, and it paints everyone with an unfortunate brush. So I know that's not the case here, but I'm just saying that's something that's triply annoying, And second thing, and I Chad's point about, I don't understand this thing about you must exit. So if you own Sandton City, why would you ever want to sell it, right? Or you own Eastgate Shopping Mall or the waterfront. So I don't understand the focus on this. And in your guys' case, where you're in a property investment, if you've got great assets, I mean, you can't replicate those in a hurry. You'd want to hold it in perpetuity, right? Warren Buffett bought Coca-Cola. He's not selling Coca-Cola ever. He's going to hold it forever. So I don't understand. I agree with Chad. Why do you want to sell good assets? That doesn't make sense to me, right?
So
But
you're a supporter of an open-ended fund structure, Adam?
I would think so. I mean, personally, I think that should be the way to go. Why do you want to close funds and then start with a new fund and then you give me back my money, then I must give you back the money again? I mean, but we've got a different view. That's our view. I understand other funds, but we are quite fortunate in that liquidity is not a big thing in our world because our contributions equal what's going out. So we can sit out the next 10 years. And then finally on climate, so climate's not big in our world because we pour fuel and we sell cars, internal combustion engine, But I find it amazing that the Eskom pension fund, climate's very big in their world, The greatest polluter in this country is worried about climate. So I find that amazing, but that's only me. Maybe other people see it differently.
Adam's been waiting to make that comment all day, Teresa.
Okay, so I'll first start with the first thing about exits, and this is the thing, and this is the experience you have as an investor. One of our funds actually held good assets for too long, up until it was not so good anymore. So those things do happen. So it doesn't mean because an asset is good now, it's going to be good in the next 10 years. So we must guard against that. And I know managers like holding on to say, oh no, let's ride and sweat this asset some more, and then the market does something
Get
like
emotionally
COVID.
attached, right?
Yes, and then the COVID happens and we've got an asset that's over-leveraged, and it's not so good anymore. So I strongly don't believe in holding assets forever. They do continuation funds where they take the assets and into a continuation vehicle. That's their choice, but they should allow LPs that want to exit the ability to exit if you want to continue with your continuation vehicle. But when we come into an agreement, we come in for a 10-year with a +1+1 extension, and we expect you to exit within that period of time. So that's what our stance is. And then when it comes to climate, I'll try and take a stab at it because it is a management decision to be part of the Net Zero Alliance, but it is because of Eskom, and it's also because of the president signed a Paris Agreement, I think, to want to reduce emissions for 2030. So as responsible investors in the country, we want to follow the South African government in terms of their ambitions to reduce emissions. And as Eskom being the largest emitter, alongside your Sasols and your other mining companies and energy companies, we thought it's prudent for us to try and play a role in that space as well.
I'm going to help you there and just say it's called a just transition, right? Not an immediate transition, a just transition. Yeah.
I just want to comment on the permanent capital vehicle versus fund vehicle. Ask any investor that's raised in this market. Investors are not willing to go into permanent capital vehicles. The people that are actually allocating at the moment, I'm not saying they shouldn't. I'm saying that there's just an unwillingness because there is still this issue around liquidity and the need for liquidity. So the problem is that unless you are willing to, as an investor, maybe with your position, being willing to take a R1 billion position where that fund manager is sustainable, at that level and doesn't require the catalyzation and, diversification within the LP capital base, because EPPF, PIC, most other institutional investors are unfortunately not willing to take a permanent capital position. And go and ask the guys that have raised permanent capital vehicles, the investors hate the model for whatever reason. They just don't like it. I know, I don't want to once again speak on your behalf, but I know that they've got some permanent capital vehicles, and it's got its own issues. So it doesn't mean that because you are in a different vehicle that it's, you know, the problem set goes away, or the need for liquidity goes away, or whatever the case might be. What makes those vehicles extremely difficult is that if you were thinking about raising DFI capital, which is not in our market available, I would say, in any event, but if you were thinking about it, they're not going into permanent capital vehicles, so you're not getting that catalyst effect in that regard. So you're kind of excluding yourself from a certain number of LPs having the conversation with you. And the other thing that I would say is that you start operating as a company that is incentivized in a completely different way to what asset managers want to be incentivized. Asset managers raise funds because they want carry, right? They themselves want the liquidity in order for them to get the carry payouts. If you fundamentally are happy as an asset manager to be remunerated in a different way with different incentives and everything else, then possibly the permanent capital. It can't be just a matter of that the asset class is what drives that structuring. It's the asset manager themselves must be willing to then operate more as employees of that structure, incentivized in a completely different way. You don't have the liquidity, so carry doesn't look as sweet as what you possibly have. So it's not just, I suppose, a investor-driven kind of, you know, structuring dynamic that's going on. A lot of it is as well the appeal of asset management, where fund structures, if you do it right and if you can create the liquidity, then you're in the carry, right? And that's what all the asset managers are wanting to be. So I think it's a complex decision. I absolutely agree that there's, you know, that some asset classes are primed for that. There are vehicles in South Africa where, you know, they've built out these big portfolios and it works really, really, really well. But they've got a captive asset funder base, LP base, that keeps on funding into that, you know, vehicle. So if you establish that, and maybe that's your consideration, is that what does the next vehicle look like? And do you have that captive base because of what you've done in Fund 1? And then you can recycle into that structure. If that exists, then that's a different conversation and you've got that structuring optionality. So it just becomes a bit more complex, I suppose, is the, you know, the short and sweet of a very long answer.
Thank you, Melanie. Just before we go into like final comments, you made an important point, Chad, and it was around team health, right? And I mean, when we talk about emerging managers, we talk about the coherency triangle, right? Team sits at the top there. And you refer to it as well, Adam. Your team has to be consistent. Your team has to be, has to be tight, right? Do you believe, as we now consider human resources, right? We have to consider our human resources as we move into our Fund 2 considerations. Do you believe there's one model is better than the other? I'm thinking about some of the other emerging managers in the market. I'm going to call them out. I think they're doing great work, like Infra Impact, Sonari. But they've got massive teams, right? They've got big teams relative to what is a very lean team at Alt Capital Partners, and Alt Capital Partners potentially choosing to outsource more and focus on key functionalities from a team member's perspective. Do you think there's a better or there's a different model that we could be thinking about when we think about our team to guard against that team welfare?
Yeah, I mean, Mel, I think we learned yesterday that, is this on? Yeah, okay. I think the psychologist is Sean, if memory serves, and so I don't know if we need to pass the mic on. But like, if I think about it, I don't think there's any right or wrong answer. It's also a complicated question because there's multiple variables that goes into that answer. I do think that I won't mention names, but there's teams or businesses that has bigger teams, but they're facing different issues. And so in all private equity funds, there's a sustainability question that comes up at some stage, especially in the emerging manager side. The bigger your team, the closer that conversation potentially comes from a timeline perspective. And so you can decide today, I'm going to start with a 20, 30 person team. Potentially not everyone can take salary cuts. Potentially not everyone can not have market-related bonuses. And so funding that at some stage, capital dries out, start making poor investment decisions to kind of close those gaps, right? So exiting earlier, et cetera, et cetera. And so I think there's a lot of variables that comes into play, and I don't think there's any, from my perspective, I would say there's any right or wrong answer. what I would ideally like is sufficient capacity to cover the key functions that's required to implement the strategy. If that doesn't exist, it becomes problematic. I mean, looking at, like I'll explain. So when I started chatting to Ben, he used to call me all the time, come over, had lots of lunches. And I was like, when I look at people, I assess what I call the hunger factor. And so I was like, okay, Ben's a little bit famished, so I get that. Right? And so that's there. And I was like, okay, kept chatting to Ben. I was like, okay, this is interesting. And then I met Toomey. I was like, okay, this guy's hungry. And I was like, okay, cool. Then I met the last person in the equation. Like, oh, he's there. I thought he left. And Kulu was like, I met him and then like, that hunger factor, like, geez, I was like, we need to call some people and feed this guy because he's hungry to just take over the world. And that hunger you can't replace, right? And so when you're comparing individuals, you need to actually look at that because I can tell you that guy, when I met him, I don't know, Ben, you need to help me. I don't know when that was, 4 or 5 years ago. I thought that he would eat, sleep, drink, apparently.
He does.
Alt cap 24/7. And I think that's exactly what we saw today. And so that factor means different things when you compare a 20-person team to a 6-person team. Like there's subtle factors that you need to take into account.
The passion factor. I like that.
Or the hunger factor.
Or the hunger factor. Okay, the famine factor. Got it. Okay, guys, we're running out of time. You've been tremendous, but let's do a firing squad round. You can say anything. What is the final thought you want to leave this room? Okay, fine.
No, I realized there's actually a bigger balance sheet that it will be remiss not to get to view. We've got Investec and RMB. So 3 questions ago in terms of, I mean, as big banks, what did they consider before funding Reimagine?
I just want to say originally this panel was going to be 7. Now my panel is like, now my panel is just the whole room. I love this. Okay, Duncan, can I hand this to you and then to RMB?
Fund level. Okay, yeah, because it is a bit different. So what we do is a bit different to the usual property finance and the underlying. It's at the fund level. So our kind of bread and butter, so we see all the SA-based PE funds. The points mentioned by the panelists is what our credit forum is actually interested in. Obviously the DPR, the Investec backs the jockey, it's quite a known term. The people behind it is very important to them, who they're lending the money to. Performance, obviously, in any credit kind of decision is very relevant. And then, yeah, we see a number of funds that have a few funds raised. So the performance is kind of a big factor for our credit members. Obviously, our view, if it's a capital call facility, we're looking at the investors' money. We're not looking down. We still look down, obviously, but the LP's strength speaks to a lot of why we can make our kind of decisions on debt at the fund level. But it could differ, yeah, obviously, if you're looking at the assets, which I can't really speak to.
Thank you, Duncan. Keenan.
I think it's easy for us. We have 3.7 trillion behind us as first loss. But I mean, I think, I think for us, I think we follow a similar approach. The team is extremely important, and expertise of the team is extremely important. I guess the assessment levels are different because I say the joke tongue in cheek, but that is a big factor. We play in the debt space. There is a layer of protection behind us. But I mean, I think for us, we kind of look at our banking relationship more than just the assets. So the asset's going to yield cash flow is going to service the debt, and there's going to be parameters that we like or we don't like. But I think more importantly is the people behind it, and are they driving the outcomes intended for the business and their strategy, and can we partner with them in doing that? So that is key, is to see guys on the ground doing day-to-day, showing outcomes that they said they would deliver on. And yes, it is early on in your fund life cycle, but from what we've seen to date, we've been quite excited about what the team's doing, and we want to partner with them going forward.
Thank you, Keenan. As has been said, we're a learning organisation, so the only thing I learned today was that next year we'll have 2 panels. All right, it's firing squad time. Who's got the microphone? You can either go one from one side, or however you choose to go, but you get a minute to say whatever you want to Old Capital Partners.
Whatever I want to all capital partners. And I'm the unfortunate one to think about the question. Yeah, I mean, I joked a little bit about that hunger factor, but like if we saw Ben presenting today the portfolio that they put together, like if I think about the 50 manager portfolio that within our emerging manager program, like it's when we go through our kind of frequently, we go through like a risk rating process and we look at all the exposures that we have. It's like we get to reimagine and we think, hey, is there anything to worry about here? I think those guys are working too hard. That is honestly the first thought that comes to mind is, I think they're working too hard, they can slow down a bit. I don't know if I told you that earlier this year when we met, is, okay, you guys can slow down, let's let this work, and then you can continue doing what you need to do. But it's like, you guys have done extremely well. I think the team's worked extremely hard. I don't know if anyone can appreciate the work that goes into developing assets, especially in the areas that you guys are working. And so, yeah, hats off to the team.
Oh, thank you, Chad. Firing squad, who's next? Bukile, Itu.
Yeah, if I had one message for the team, you know, aspire to be the best place to work at, right? You know, really drive a culture and an environment that all of the key staff members would really, you know, kind of thrive, grow, and really just admire to be in that space. I mean, the accolades around best place to work and all of that type of stuff. But I think if you get that lever right, you know, the portfolio construction, the composition, the capital structure, all of that stuff follows because people are engaged, people are hungry, people apply themselves, people feel that they're part of this journey, they're part of the story. So this is something that, you know, it's funny sharing it with the one person that I think has it. You know, really just, you know, put the people first, the staff members, and then everything else will follow.
I don't think I have much more to add. The only thing that I would say to any fund manager is to always keep in the back of the mind whose money it is. And in my case, it's the guy who's putting petrol in your car. That's the guy whose money it is. The guy who's spray painting your car when you've had a ding at a panel shop. So just keep that in mind. And for most of these people, this is the only money that they've got. They're living hand to mouth, and this is all that they've got that their family has had. So, you know, just always, I mean, I think of that all day, every day, and I just encourage everyone else to just keep that at the back of the mind. You know, everything else is all relative.
The North Star. Thank you, Adam.
My 2 cents contribution would be that you've got a very strong value proposition in terms of your product. So what we want to see now is the financial returns to seal the deal and to really, seal the deal proper for your fund too. I would think that would be the missing piece. But of course, there's a J-curve element right now. Still new, but if that could pick up properly, and I think earlier you said that your estimated return according to your model is about 15%. So I'm not sure if that's gross or net, but I hope it's more on the net side. I hope it's more on the net side, and if you can achieve that, you would have solidified your product.
Done. Thank you, Khabang. We'll be there for round 2. Teresa.
I know it's 7 years away, but you know, to the team, you started strong, finished strong. It would be a shame if at the end, the exits aren't what they should be, So, yeah, I think that's what's on our mind going forward.
Finish strong, got it. Madai.
Given that I'm not an investor, I think that to continue the level of transparency with which I've kind of experienced your reporting and everything just through the course of today, the conversation, the transparency of the conversation, I think is absolutely critical. I think that, once you start like living as a asset manager, this, I'll say this next quarter or I'll report this, then you start losing the trust from these guys that, are the ones that will be funding your next fund. So I think that certainly, we spoke about trust more conceptually. I always speak about kind of the human element of it. I would implore you to continue in the trajectory which I think you're already on, and just do more of that and rather overshare. And congratulations. It's not many fund managers that have a whole LP panel of investors complimenting them. So, well done.
Thank you very much, Madai. Thank you very much to the panel. I just want to say, if you thought we weren't serious about diversity, gender parity, and all of those things, just look at our panel. Our LPs represented. No, but we are privileged. We are honored. We know it takes time away from your stakeholders to be with us today. Thank you for the transparency. Thank you for the openness. And thank you for holding us as we go through this journey. Ladies and gentlemen, another round of applause. Thank you very much.